Good morning, everyone. This is Charalambos Pissouros, Senior Analyst at IronFX, bringing you the morning comment for the 7th of December. And the central bank torch is passed to the Bank of Canada. The highlight on today's agenda is the Bank of Canada monetary policy gathering. Expectations are for the bank to hold its fire at this meeting. We agree amid mixed Canadian economic data. The Bank of Canada struck a somewhat neutral tone the last time it gathered, an upgrade from its previously dovish stance. However, in the press conference following the decision, Governor Pissouros backpedaled on the bank's neutral outlook by indicating that policymakers actively discussed the possibility of adding more monetary stimulus at that gathering. Since then, economic indicators have painted a mixed picture of the economy. Although the labour market tightened in October and GDP growth was stronger than expected in the third quarter, the nation's core CPI rate slipped in October while its current account deficit widened in the third quarter. Pissouros said in recent comments that the current account balance was likely to clear the bank's outlook, and as such this data could warrant a shift back to a dovish stance by the bank if viewed in isolation. However, this is not our base case scenario. We believe that the Bank of Canada is likely to be content with the OPEC meeting outcome and the subsequent surge in oil prices, considering Canada's heavy dependence on oil exports. Thus, we expect the bank to maintain its somewhat neutral tone in its policy statement, especially considering that the latest gains in oil prices and the optimism in energy market may be sustained for a while. Dollar CAD has been in a short-term downtrend following the downside exit of a descending triangle that had been containing the price action from the 9th of November until the 1st of December. During the European morning today, the pair is trading slightly above the 132.70 support level, and some optimistic points in today's statement may trigger a break. Something like that may initially aim for the next obstacle of 132.30, and if the bears are strong enough to overcome it, we would expect them to set the stage for extensions towards the 131.70 territory. Overnight, Australia's GDP for the third quarter came at minus 0.5% from plus 0.5% in the previous quarter, missing estimates of a slowdown to 0.3%. The nation's economy probably shrank as businesses, consumers, and the government all scaled back spending throughout the quarter. This was the largest contraction for the Australian economy since 2008 and threatens both the first recession in a quarter of a century and the country's AAA credit rating. The S&P Global Rating Agency has warned several times that there is a likelihood to downgrade Australia if the government's promises for a surplus by 2020 were to slip again. As a result, this figure is a headache for the government, as it may prompt a greater fiscal response and thereby delay the budget getting into surplus. What is more, the danger of a recession may force the RBA to alter its plans. Yesterday, at its last meeting for the year, the bank once again gave no signals on whether it plans to ease again in the foreseeable future and judged that by keeping rates unchanged, there are reasonable prospects for achieving sustainable growth. The Aussie slid on the bad GDP figure, and given that this lit the spark of speculation that the bank may consider taking action at its upcoming meetings, we would expect Aussie dollar to continue trading lower, at least in the near term. The pair fell below the support now turned into a resistance barrier of 0.7440 and stopped marginally above the 0.7410 line. A break below the latter level is possible to aim for the next key hurdle of 0.7365. However, we stick to our guns and we believe that Aussie will not move in a similar fashion against all its counterparts. For example, we still expect it to outperform the yen, especially following the overnight comments by the Bank of Japan Deputy Governor that the bank won't hesitate to take additional easing steps if needed. As such, we would treat the overnight slide in Aussie yen as a corrective setback. As for the rest of today's events, the European day begins with Germany's industrial production for October, and expectations are for a decent rebound following the previous month's slide. Coming on top of the spectacular increase in factory orders for the month, this would add to evidence that the Eurozone's growth engine is gaining steam. We get October industrial production data from the UK as well. The consensus is for a minor rebound following a modest decline in September. However, given the slide in the manufacturing PMI for the month, we remain skeptical on whether industrial production could meet its forecast. A miss of the forecast is possible to hurt somewhat the pound. No speakers are scheduled on today's agenda. For more information, including technical analysis, please read the full comment on IronFX.com or download our app and get all the information you need to trade. Also, you can follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Charalambos Pissouros, Senior Analyst at IronFX, wishing you solid trading.